Well, the balance sheet. We want to kind of go into what it is. Okay, the balance sheet is it's just like taking a picture. It's a moment in time for the business. So a lot of times you'll hear it described as a snapshot of the business. It's for a specific date, typically. Not could be for a moment, but and most of the time we'll run a balance sheet if we're not in tune with our finances all that much. We probably do it at the very end of our fiscal year. If we have a January through December fiscal year, then we run a balance sheet for December of that particular year. That becomes the beginning balance sheet for the next year, the next fiscal year. Okay? So that's the typical time. Once you get into business and you're looking at these things and trying to make some decisions, you're probably going to look at them a little bit differently and actually in a more timely fashion throughout your period. See how things are changing. Again, it's only a snapshot. It's not a motion picture. It doesn't show everything in totality, but if we just stop time and we actually take a look at our business, that's what a balance sheet does. It is the epitome of the accounting equation. And I wanted to pull this up as far as our textbooks go, and I think it's a good graphic and showing that. A lot of times you'll see on one page, you'll see your assets on one side and your liabilities and net worth on the other side, just like the accounting equation. Okay? We can categorize the different assets, liabilities, and net worth items within those categories, but this is the basic structure. You may also work with a balance sheet which goes from top to bottom. So just familiarize yourself with that. We actually have a few examples later on that will show you on those sorts of things. Okay? So that's a balance sheet. It is actually a snapshot, and it is the accounting equation. So if you misstep on your accuracies during any time period before you take the snapshot, then you're not going to have an accurate reflection on your balance sheet. All right. So let's get back to the slideshow. So it shows the accounting equation. With this equation, if we know two of the variables, we can always solve for the other one. So liabilities, you can fill in the blank there. Owner's equity, you can also fill in the blank for what that equals. So that's a fairly easy one to figure out. The balance sheet shows us two things about the business, and that would be your liquidity, which refers to how easily assets can be converted into cash. And just to give you some example, like your checking and savings accounts, those are really easy to convert into cash because they are cash typically. Okay, and we can have access to that cash very quickly by writing a check, using our debit card, that sort of thing. There's a few other things in the liquidity category that are fairly readily available to us, and we'll get into that as we go. The solvency, as an issue in analysis of the business, is the ability of the company to meet its long-term financial obligations. So we're taking a look at is this company, does it have a future? By taking this snapshot, as far as does it have enough assets that if it had to, under disastrous conditions, liquidate them, even the long-term assets, and actually cover all the financial obligations that the business actually has. And if it doesn't, then you're typically, if you're not in bankruptcy, you're in pre-bankruptcy, and you may not even know it. Okay? And we want to avoid that by actually taking a look at these statements on a regular basis to see what trends and some analytics are, so we can determine our liquidity and our balance sheet. Some of the ratios we're going to calculate are actually going to give us a pretty good reflection on that sort of thing, but you can also just look at the balance sheet, look at the snapshot, and get those kinds of questions answered. So the balance sheet has all the assets on the left side, all things in or owned by the business which have value and generate income. Okay, so the liabilities are on the right side, and that's all the obligations of the business, all the debt, for instance. Okay, so that would be anything from an account we have down at the feed store to sorry about that, guys. So anyway, and the owner's equity is what actually the business owns, and typically if you're the head person in that, you probably have the lion's share, if not all the share, of the owner's equity. That's what you own in the business. You can look at the accounting equation. I think I pointed it out before too, but just to reinforce that again, is that your liabilities and your owner's equity side of the equation actually tell you who owns what, or percentage-wise, we can determine real quickly, of the total business, which is the assets. Okay? So we want to break down these categories within the asset class, and the current assets are all those things that we could reasonably expect to be converted or already are cash within the next year. So in the next 12 months, we could reasonably be assured that they will be converted or can be converted into cash. Okay? And the other thing that we wouldn't put assets in here which are our factory. And for instance, in ag, we talk about the cow or the ewe or the female part of it, and the bulls too, and the male end of things being those that are actually the factory in the process. So if we sell those, then we can't generate income. So we wouldn't want to just liquidate those, and those would not be considered current assets. There's some other categories that we would have in here, for instance, prepaid expenses. So when we were talking about accounting before, and I bought that fertilizer in December of the prior year and used it on the next year's crop, that would actually be a prepaid expense. It's actually an asset account that will actually be consumed or converted within that year, and we're going to expense it as we harvest that particular crop. And you can think of lots of examples where prepaid expenses. Typically, we pay for insurance on a prepaid basis. So it's for the next quarter, or it's for the next half a year or full year. So that would also be a prepaid expense. Some other things, if we have maybe a brokerage account or a hedging account that we're going to be using in the next year, that would also fall under a current asset. Okay, there's some others too, but those, hopefully you get that. Now, if I've got grain in the bin, or I've got hay in the stack, or I've got calves which will be weaned this year, those would be inventories that would show up. They'll be converted within the next 12 months, so they would show up as a current asset. Okay, and if you're a shop owner and you have some inventory that you plan to sell in the next 12 months, those also would be considered inventory. And I say these kinds of things, some of you are strictly production ag. There's a lot of you that have a side hustle, or maybe even something that, like, they have your own in-house side business, which you actually have those things. So those would be considered current assets. The next one is called a fixed asset. And We're going to look at a couple balance sheets, and this is where, you know, I don't get discouraged, but if we're going to act like a business, I feel like we ought to be a business, and we ought to actually report like a business, okay? And that's somewhat of an opinionated thing, but it's backed up by generally accepted accounting principles. If you're taking an accounting class, you'll never hear about intermediate assets and liabilities. But we do in agriculture because we're special. We're not special, especially when a business is a business is a business. And I think it needs to be evaluated so that we can compare against other businesses. And that's the major reason why I don't really like to talk about intermediate assets, although we will to a certain degree in this course. And the textbook actually emphasizes them and posts them within your balance sheet. But a fixed asset is actually, by generally accepted accounting principles, is anything, it's a long-term tangible property that a firm owns and uses in the production of income. Okay? Your factory, your cows, all the females, and your bulls. All those things that actually produce an outcome, not themselves, but comes out of them in order to generate revenues for the business. Okay, and also, so anything you use in the process, so tractors, vehicles, those kinds of things, land, improvements to land, dwellings, those kinds of things would be considered fixed assets. So it's not something that you're going to convert. If you had to convert a fixed asset into cash, it would actually hurt the business because you wouldn't be able to generate income. So that's the difference between those and the current assets. Just a little bit of an aside, in the textbook it has a good definition for intermediates. It's anything that has a useful life of between 1 and 7 years, typically. Okay, so cows, machinery, that kind of thing would fit into those kinds of asset class. If we're going to take a look at a balance sheet which has intermediate assets, I don't mean to confuse you on that. For me, even though I'm in the ag field, I feel more comfortable just treating it just like a business where we have current assets and fixed assets, and it also fits my mantra that says keep it simple. Okay, but anyway, I think you need to be familiar with those things, and you can choose with your own operation. Okay, let's go on to the other side of the balance sheet, and that would be the liability side. Is in the upper right hand corner. Current liabilities are all those liabilities, obligations, debt that you will be responsible for, the business will be responsible for in the coming next 12 months. Okay, so those are easily identified too, but there may be a few that you haven't thought about. Of course, the line of credit that you have for your business to make up for any discrepancies in cash flow within your business. As you borrow that, it's got to be paid back in a minimum of 12 months. So that would be a current liability. Some other things that would be current would also be the line of credit that you have at the feed store. Maybe you pay your electric bill on a quarterly basis, for instance. That would be something that as it accrues, and that's the definition of accrued, would be something that actually you owe but you haven't paid yet. Okay? So, and again, in a practical sense, we may not, or we may put those down. I would say if we have a quarterly bill, we could really put an accuracy to our balance sheet if we reflected that as a current liability. Okay, but if it's on a monthly or a half a month or something like that, the practicality comes into existence there, and we're probably not going to post that on our current liability. balance sheet. So anything that's accrued. Some of the things that some people miss would be, we may have some debt which is long-term, okay, and we'll get into the definition of that in a second, but we pay the interest on it on an annual basis and up front, okay? So that would be an accrued interest expense. We would also have an accrued principal payment possibly due on those debt too. So anything that we owe on that's long-term that's due in the next 12 months would fit into this category. All right? So there's going to be some others too that you can think of. One other that I thought of, let's go back to the asset side of things that would fit under current assets, and that would be an accounts receivable. And we may have a few within our an agricultural production setting, but if you got a side hustle where somebody owes you, you're probably going to have a large accounts receivable. That would be the people owe you, okay, and they're going to pay you in the next 12 months. It will be converted into cash going to your checking account at the time they make payment, and you want to track that. So accounts receivable, another good current asset account for most businesses. Agriculture doesn't deal with it a lot, but even a simple business setup will actually have an accounts receivable current asset account. Okay. Long-term liabilities. Okay. Those are all those that that are due and payable, that are far out there in the distance, more than 12 months typically. Okay. Again, following generally approved accounting principles. We in ag, we kind of treat ourselves special. Again, I hate to just talk a lot about it, but we also have intermediate liabilities, which are liabilities or obligations on those assets which are intermediate. Okay, so it'd be your factory and your vehicles and your tractors and those kinds of implements and those kinds of things. If we have any debt which is due and payable in the next 1 to 7 years, we classify them as intermediate, and we put them under that. Again, I would rather just keep it simple. Long-term liabilities and current liabilities. You might also, as you read others' balance sheets, this may be referred to as fixed liabilities and fixed assets. They're the same thing as long-term. Okay, so that would be mortgages. That would be the tractor payment or principal that is owed on that particular piece of equipment. Or if you have a loan on cows or on sheep or anything else that is due and payable in more than 12 months. So a really simple kind of. All right, owner's equity. There's the accounting equation. Owner's equity equals your assets minus your liabilities. It's your ownership, or those that are involved in the business's ownership in the business. Okay. So some owner's equity accounts that we talked about a little bit about this under our T account examples. We would have, first of all, retained earnings, which is profits that are generated within the business that are kept in the business to be used for growth. We might even just set it aside, but it stays in the business so that if something were to happen. And I always try to counsel people, especially in agriculture, where we're actually not only attuned to the changes in the markets and the possibility of not receiving as much for our product as we expected, but we may have disease issues, we may have some weather issues, Those are things that have happened in the recent past that we may deal with. Other small businesses deal with other things that can be fairly volatile. And so I always say you should keep some of that in the business just to make sure that one of those events doesn't actually cripple you too badly or put you out of business. So owner's equity accounts that we've got listed here that are very typical would be your owner draws accounts, and then your capital contributions by the owner. Typically, when we set up a business, you're gonna put some assets. It can be in the form of long-term assets. It can be also in the form of cash. And if you have a group of people in partnership or shareholders put together, then we would actually put those things down as your contributions individually. So we have a record of that within the owner's equity accounts. And then all the revenue and expense accounts that are actually going to be posted to the income statement fall under the owner's equity accounts. Okay? And that's going to be reflected in the net income figure that's going to be here, or retained earnings, or retained earnings. But we'll show you how those things weigh out as we go along. Okay? For one of your assignments this week is actually, and I'm going to move this over here, okay, is to build your own balance sheet, okay? And it's going to be right in the assignment module that you'll upload. And I may even use a few of you. Don't want to spook you or anything. I do in the in-class version of this class is take them up there. You need to get comfortable. I mean, if you are a poor college student, that's just the way it is. Okay, so anyway, don't want to scare you off, but I want you to take the basic framework here and put everything. I want you to come up with your net worth. That's synonymous with owner's equity. Okay, so you're going to list all of your current assets. There's some examples here. You can change it. Add up all your current assets, add up all your fixed assets, current liabilities, and your long-term liabilities, okay, and come up with a owner's equity figure. Then we're going to calculate the current ratio, working capital, debt to asset ratio, and all those kinds of things to determine your liquidity and solvency, and you'll be able to make an assessment. Don't be too concerned if it looks kind of dismal. Some of you are going to look better than others. Don't compare. This statement, although comparative analysis is a good thing to a certain degree, but the main thing that we want to do is like, how can we improve this? How can we set some goals so that one of our goals, which actually means something, we want to improve our owner's equity by at least $50,000 in 2019. That would be a very specific goal that we could monitor and tell if we hit the target or we didn't. So actually, we can use these instruments, these statements, and the balance sheet in order to come up with some very specific and measurable goals for our business, so that we're just not out there operating. We're actually headed in a direction, okay? One of the things that I want you to do within this statement is actually look back on these numbers or ratios and actually make an assessment. Tell me about it, okay? Doesn't look too good. My current assets, I'm fairly illiquid. I'm very liquid. I've got too much short-term or current debt for what my current assets reflect. So, I mean, make some assessment, or it looks pretty good. I can cover all my current debt. It looks a little dismal as far as my solvency and being able to service all of my debt or my fixed liabilities. Anyway, just wanted to give you a little assessment on there. I've got a little bit more to talk about in as far as the ratios go and how to read them, how to calculate them, that sort of thing. I'll put you a different video so you don't have to watch a video for very long. This one's getting plenty long. So hopefully you hit the pause button and came back to it.